So I would normally be introducing him, but you've already met Eric. So I'm going to go ahead and I won't introduce myself, but we are going to welcome to the stage V. Lee, advisor to Anchorage Digital, Laszlo Szabo, co-founder and CEO of Kiln. We're going to be talking to you a little bit about some of the more experimental applications of what Eric just addressed. And thank you. Yes, yes, please. Round of applause, round of applause, round of applause. Woo! I think the dynamic here is a little different because Eric was on stage and I'm also introducing and moderating. But as you already saw from Eric's talk, the crypto ETF space is rapidly maturing. Here, let me come over here.
Come close.
How's it going, Laszlo? The ETF space is rapidly maturing. And we've already got a number of spot ETFs that have been approved, Ethereum, Bitcoin, a lot of pending stuff. But we want to take a closer look at something called stakeable ETFs. This is a concept that until relatively recently was only theoretical. Thank you. Europe is taking the lead in stakeable ETFs. The US is closely following. But for those of us that don't know what stakeable ETFs are, just really quick, could I get a once-over, sort of like what's the difference between a stakeable ETF and a traditional ETF? And what's been sort of the delay in why we've had all these other ETF approvals, but there seems to be some apprehension for letting this kind of new kind of ETF go forward?
Yeah, I mean, if you want to define that, you have to define staking first, right? So historically, Bitcoin is a mining protocol, but staking is this concept of bonding your native assets, let's say ETH or Solana, to get in return rewards from the network, inflation plus the network fees that give you like a yield. And this yield can be unbaked. It's the natural way of securizing and validating transaction on Solana or Ethereum. And that can be unbaked in an ETF. Because today, ETF in the US are only offering an exposure to spot ETH or spot Solana. But in Europe, for example, in Hong Kong, you start to see ETF where you get the exposure to the ETH or exposure to the Solana plus the rewards linked to staking on top.
And so just to clarify, there are assets behind these ETFs. You're traditionally not allowed to invest them because they're literally backing the ETF. So there's not yield, there's not interest, there's no revenue income being generated from the assets that are behind the ETFs. What is so concerning? Why are we moving so slowly into this world where the assets that are backing these ETFs might also be generating additional income?
Is that to me?
Yeah.
Yeah. The 40 Act allows you to lend up 33% of your stuff. So like, for example, a small cap ETF can lend out some hard to find small cap stocks to hedge funds who want to short them. They get a little fee for that. And that can actually add to their return. So there is some examples of this. However, that's in the 40 Act. All of the spot ETFs are in the 33 Act. I won't bore you, but it's a different rule, and you really aren't supposed to lend out anything in that act. Now, this SEC is more open-minded. The other issue is, if you let 33% of your ETH get staked, it's not that much of a yield, right? What would that be, like 1% or less? Something like that?
1% for what, you said?
How much if you can lend out 1/3 of the ETF, or stake 1/3, what would that be in annual, 1% a year?
On ETH, so if you can lend, I don't know, but if you can stake them, I would say 1% on ETH and 3%, 2 to 3% on Solana, yeah.
Right, so Solana in particular get a little extra bump. But the idea is to lend more than 50%, maybe even 75%. And so right now, the SEC has asked issuers to come up with solutions. And I've heard the SEC is very open and willing. So we'll see what they come up with. The good news is, I've never seen an ETF. Like I said, I showed you the charts. ETF users are smart. They tend to hang in the funds for a long time. They don't get panicked real easy. I've never seen an ETF where like 100% of the people leave. So I think you could stake up to 50, 60 with even having to go into the 40%. Like it really won't be a big deal. Plus, one solution they may use, there's a senior loan ETFs. And those are very illiquid, and so what they have is credit lines. So they have like a way to get access to meet redemptions for stuff that's illiquid. So it's creative. They'll figure something out. We don't know exactly what they're going to do yet.
Dee, go ahead.
Yeah, just to take a step back, right? Like I think Eric, you're referring to some of the risks that the SEC has had concerns about, which I think has been a blocker for them approving any staked ETFs yet. Historically, under the previous SEC leadership, it was mainly a legal one, right? So as you guys recall, the SEC went after a bunch of exchanges for providing staking as a service, saying that it was a security. Those cases have since been dismissed under the new leadership, so that's no longer a blocker. But before, issuers weren't even asking for staking in these crypto ETFs. It was just a non-starter. So that's not an issue anymore. But of course, there are other investor protection and just structural risks, right? So one of those is a liquidity mismatch, right? So you might have a mismatch between redemption rights, right? So in traditional ETFs, investors typically are able to redeem on a daily basis. Of course, there is potentially conflict between that and the unbonding periods, which can range from hours to like 7 days or I don't know what.
7 days for Ethereum,
Yeah, so
2 days for Solana.
Right, which can expose the issuer and the investors to risk, right? So, if you see a surge in redemptions, for example, there might be a delayed ability for investors to redeem, to unstake their ETH. The issuers might have problems meeting that demand. That could lead to panic selling, right? It could lead to a conflict in calculating the NAV. There are a lot of issues that can come with staked ETFs that just don't exist in the traditional ETF context. So I think those are things, like you said, the SEC is trying to sort it out. They're working with the applicants to figure out ways that we can address those risks.
And that redemption period is perhaps starting to play out in real time. We had some news in the last 12 hours or so, unconfirmed, but multiply anonymously reported that the SEC had requested multiple S1 applicants to refile for a sole ETF. If I could ask the panel, I know the couple of you have been following closely, give a quick little overview. What just happened, and where does that put us as far as the development, as far as whether or not there might eventually someday be a stakeable ETF approved?
Yeah, I think the events of the past months has been quite exciting and quite changing compared to what happened the past 3-4 years. As you mentioned, the prior administration would be very anti-staking and would state even that these staking assets would be securities. The new administration started to cancel the file that they had on major exchanges that were offering staking in the US. What happened 3 weeks ago now is the SEC essentially saying that staking is not participation in securities actions. It's essentially part of the protocol, and these protocol, when they are commodities, then staking would be part of the CFTC scope. So it seems from our information, either in DC or working with these ETF providers in the US, that the SEC really understood the risk of the bonding period, which is changing from Ethereum to 7 days to 2 days for Solana, and might be willing or interested to push staked Solana ETF very, very soon, to my information.
What is the difference between an unbonding period of 7 days compared to 2 days? And how does that compare to the traditional way that it works in an unstakeable ETF? Why is that time difference so crucial?
It's baked in the protocol to increase the security of the protocol, right? In a proof-of-stake protocol, the security comes from this bonding assets. It comes from the fact that Ethereum has 80 billion staked to validate and secure all the transaction, all the meme coins or stable coins or security tokens that are represented on Ethereum. But if you can unstake in a complete liquid way without bonding this 80 billion, you can expose the protocol to massive attacks, essentially. So Ethereum has taken a very conservative approach, 7 days. It actually varies depending on the queue, exit queue, but it's usually around 7 days at the moment. And Solana is taking a slightly more aggressive approach with 2 days.
It seems kind of like leaving free money on the table. Is it riskless? How much risk is it? Are we really protecting investors, or is it just a fear of technology? Can we get a little bit into sort of the why behind the slow adoption to what's been going on outside of ETFs for years now?
Yeah, I mean, we talked a little bit about risks like the liquidity mismatch. Another risk that staked ETF investors are exposed to is something called slashing losses, right?
Talk to us about slashing. So what is slashing?
Yeah,
for
so
people?
slashing is basically just, if you stake your assets, you can lose some of them through slashing. If you engage in, I'll call it like misbehavior, right? It can be both intentional and unintentional. So unintentional is if like your validator node goes down and you experience downtime, right? That's very disruptive to the protocol. Something intentional and malicious could be like double spending or validating blocks that are not valid, things like that. And so it's a way to incentivize good behavior by validator nodes, right? So investors are exposed to that. I think the risk is pretty low, but it is a risk, right? And so it's something that like the regulators have to think about. Yeah.
Do we have any insights into why Europe was out ahead first? We've already there's been multiple ETFs, multiple stakeable ETFs already approved. Obviously, the U.S. is doing its best to catch up. But what was going on behind the scenes there from a regulatory perspective that allowed that to be set up?
Do you want to take this one?
Yeah, I mean, Europe, there's something called UCITS. None of these are in UCITS is like getting a real ETF approved in the US. You can approve ETNs and ETPs pretty easily in Europe. I mean, they've got like 5x NASDAQ here. They've got crazy, you guys know how to party. Although we always talk about it, you're the wrong market for it. If you guys put some of your stuff in the US, it would sell like hotcakes, but nobody really cares here. It's not the same gambling culture as we have in the US and certain Asian countries. So it's kind of wasted here, but you've well advanced. You've got staking and it's just different, under that structure you can get it out easier. The US, every ETF that gets approved is straight to prime time, meaning it's on every exchange, middle America, so they have to be a little more careful. But even Canada beats us to market a lot. We'll like file something, get the idea, and they'll beat us to market with it. That's how, even the first ETF. So over time, though, I think Europe and Canada are incubators for our regulators to say, oh, it's fine. When I go to the SEC, that's what I tell them. I'm like, it's fine. And the ETF structure is very durable. And just one quick thing on liquidity mismatch. I agree that if you have staked ETH and 80% of the people want to leave, and you've staked 50%, you have a problem. But even in that extreme case, the ETF will still trade. The market makers will give you a price. It'll be very dislocated from the NAV. But this is what happens in the COVID sell-off and other sell-offs in bond funds. The bonds don't trade. They're totally frozen. Egypt ETF traded on even as the Egypt stock market closed for a year and a half. So ETFs are a good vehicle in that even if you dream up the craziest situation of the underlying and everything's frozen, the ETF will still trade. That said, the regulators don't want to have it come to that. So they want to see what's the right medium between how much we can let you stake, precautions in case there's an emergency, versus we understand the ETF's a great vehicle for putting almost anything in. So I'm very confident that they will work this out. And as I said earlier, after what you filled in a lot of blanks for me, thank you. The ETFs tend not to see like 80% of the people rush out of them. Mostly people go into ETFs, they're smart investors, they don't panic that much, maybe 10%, 15%. I showed you the Bitcoin, only 95% of them stayed in the Q1, even though the drawdown was pretty steep. So I wouldn't look for anything like more than 20, 30% withdrawing, which gives you a lot of room to stake, I think. So I think it'll all work out and be fine. I have no doubts, really.
Yeah, if you look at some of the prospecti of other jurisdictions like Canada and Switzerland, Germany, I think the UK has also approved a staked ETF. If you look at some of their prospectuses, you can see how they're addressing some of these risks, right? So they'll use insurance to cover slashing losses, that one of the risks we just talked about. They'll allow early unbonding. Some of them engage in like alternating reward schedules and payout amounts.
Yep.
So they're experimenting with different ways that, obviously the regulators have become comfortable with. And actually what I find really interesting is the SEC just put out guidance on staking like a week or two ago. And they say like your typical staking as a service is not a security, right? So they've clarified that, which is
Step
great.
one, not a security.
Yeah, but what I thought was especially interesting about that guidance is that it referred to what it called ancillary services and said that those also aren't securities. So those were things like covering slashing losses, allowing early unbonding, and allowing the provider to alternate reward schedules and payout amounts. So it's addressing exactly the risks that they've been concerned about in the past and saying that those aren't securities, right? So I think that's like perfectly teeing up their eventual approval of staked ETFs.
It is absolutely fascinating. The 3 ancillary services that you mentioned are great examples. Also, you talked about insurance. If you put those 4 together, it does sort of like make me think of like if you're an entrepreneur, how do you play this? Like there's a lot of opportunities to build towards a stakeable ETF future. Like are there business models out there that you guys are exploring, that your companies are exploring, that you're seeing out there that you think are interesting, where there's young startups or heck, maybe Goldman Sachs or BlackRock that are building towards this future where ETFs are staked and there needs to be insurance and all of these other services provided?
Talking about insurance comes back to talking about slashing and the risk of staking, as you mentioned earlier. So if you take the staking market cap, which is $200 billion of stakeable assets that are staked, and I think we're talking since 2021.
So just to be clear, $200 billion of potentially stakeable, actually stakeable.
That are
okay.
staked. That are staked.
Great.
Across, so 40% of that are ETH, 30% of this is Solana, and the rest is 100 different assets.
I want to make sure we're clear, because I want to make sure it's clear to everybody, like sort of where we're at as far as the maturity, the opportunity, the size of the market, et cetera. So go ahead and continue.
Yeah, that's right. And only a couple of millions have been slashed since 2021, because the risk is, you can call it, kind of the risk-free rate in crypto, what money market funds are in traditional finance, where your central bank is the counterparty. In that case, staking your ETH or staking your Solana or ETH are your counterparty. The risk is quite minimal, though you still need to be insured. Usually, we are insured as staking providers or company offering staking services to 3 to 4 times the amount that has ever been slashed on Ethereum and Solana. And then will Goldman Sachs or the large asset managers offer staking services themselves. They usually tend to partner, but there's definitely ways and products that they will be able to build on top.
Eric, you have different perspectives, wildly different careers and professions. Like, what are you seeing as far as possible business opportunities in the future of stakeable ETFs?
Look. The Ether ETFs took in 10 billion, or they have 10 billion in the US. What would they have had if they could stake? I'm going to go around 10 billion. I just don't think this is a huge game changer. In my opinion, Solana may be better because 7% every year, that's a nice little kick. But it's not going to show up as yield, I don't think. I think it just gets baked into the total return. But if you start off with like 7% ahead of the starting line every year, that's pretty good. But remember, there's things you can buy in the ETF market that yield 10%, 20%. They even have some that yield 100%. So there's a lot of competition for yield. I think the bigger issue for these coins is which one gets the network. To me, and maybe I'm wrong.
Can you clarify when you say which one gets the network?
Yeah, like basically, correct me if I'm wrong. I'm a little bit of a newbie at this. Bitcoin's a different thing. It's a different animal. It's basically indestructible money, digital gold, scarce. It's over here. The other ones are all like little tech stocks. Which one is going to grow? Which one's going to get maybe some revenue from that growth and build a network of users and people that use it and companies that use it? That and any potential revenue from that is like a tech stock, having starting to get bought up. Which one will sort of win a race? They all seem like, a lot of them seem like they are again, competing to build these blockchains that can service the most amount of people and corporations and then monetize it. Staking is a part of that, but I'd rather have the one that really wins that race than the one that happened to stake more. Because there's a lot of stocks that yield, REITs, real estate investment trusts, yield like 6-7%, but like they suck performance-wise. So like, what's the point of getting that if you can't? I'd rather own NVIDIA. So I think this is for at least US investors, it's more important to get that winner. That's why I think a basket may be good of all of them, like an altcoin basket. But this to me seems like it's going to matter more. But if Solana has a 7% lead every year because of the staking, and ETH has a 3%, that will help those two. But they also need to do the other part of growth. Did I miss anything?
Yeah,
there?
no,
Go
I
ahead.
think that's right. I mean, just like a traditional ETF, which typically doesn't consist of just one asset, right? So I think two factors will probably lead to that. One is people are going to become more comfortable just buying crypto on the spot markets, right? Like, we have market structure legislation coming that is going to provide a clear framework for crypto exchanges to become regulated. I think more retail customers are going to become comfortable buying crypto that way, making ETFs that consist of just one digital asset probably less popular. So I think you're going to see that. It's going to become more like traditional ETFs where it is a basket.
Hold on. This is an important topic, and I want to get your take on this. Okay, let's say you've got these exchanges that get you direct crypto. Have you guys seen the exchange rates on these things, especially if you're new? They totally hose you. I went on myself. I tried to get like Bitcoin, just Bitcoin. The cheapest I could get through this cold wallet I got was 2%. So then I went on, someone said, oh, use the professional thing or whatever. So I did that, I got to 1.5%. That's crazy to an ETF person. ETFs are 1 basis point to trade. So I will say, when all the spot is directly available on these platforms, will they be able to get you down to a couple bips? If they can't, I still think the ETF will win over spot because that cost is huge. You're talking 10 times, 100 times cheaper.
So if I could, real quick, shots across the bow fired with Laszlo here. So
Yeah.
we got to give him a chance to respond.
I'm commenting on one of your comments, not on the commissions between exchanges and ETF, because they're both our partners and customers. So I won't comment. And even if what you say seems very true, but what you said on these coins.
I'm so sorry. Let me do the journalist thing. When you say, what exactly are you responding to here?
1.5%, so it's essentially 150 bips
Okay.
for exchanges versus a couple of bips for ETFs. 150 bips, I guess, in traditional finance is like, what is that? Right? It's like, what are we talking about?
That's what they used to pay in the 1970s to a stockbroker. I mean, it's like 50 years old pricing.
Right. So I said I wouldn't comment. Maybe I did already, but on what you said on these platforms, will win in the end? Solana, Ethereum, Sui versus Bitcoin, which Bitcoin has narrative, digital gold, and that's different from being a decentralized developer platform where you build application, change the financial system on top. And I think I agree. Like, you need to have users, and ultimately the market will price the number of users, the number of transactions on these chains, where it will impact the price, and it will impact staking yield. Staking yield are coming in majority from transactions on these networks, right? So do you invest in NVIDIA because they give you 7%? No, you invest in NVIDIA because it has high growth. You also invest in Solana because you're not looking for 7% additional at the end of the year. You're looking for more than that at this moment because it's a high risk and high return assets. But you will get the staking yield according to the number of users and number of transactions on these networks. So these are very well connected, I would say.
I was just going to say, I think with regulation is going to come more competition. And so I think a lot of the TradFi players are going to enter the crypto spot exchange space and fees will come down.
in addition to the fees coming down, are there other effects of these larger players getting involved? It is very early days, but that's why I like it. That's why I find it so interesting. I also find it so interesting because I love it whenever my home country, the U.S., falls a little bit behind and Europe takes the lead. It's fun to root for Europe, and you guys are winning here. So, like, what happens next as far as when we start to see more maturity, when we start to see stakeable ETFs approved in the US and elsewhere around the world, when we start to see more stakeable ETFs approved here, like what are the follow-on effects? Are there other products that are built on top of that? How else can we monetize the ETFs once they're out there?
Well, I'll just say, I'll be very brief. I call it getting the ETF treatment. There'll be a spot Solana that'll yield staked, will yield 7%, 6%, depending on how much they can stake. But then they'll take that and they'll write options on top of it and jack you up to 25%. So that'll be called a covered call Solana staked. Then they'll come up with like double leverage staked. So you get like 14% plus the leverage. Then they'll come up with inverse. Then they'll come up with buffer Solana. And then they'll do like Solana minus Ether plus Bitcoin. I'm telling you, they're going to throw they call it the spaghetti cannon. It's just like, and then a couple things will stick, and the rest will kind of go into the wasteland, and that's called getting the ETF treatment. So I think a lot of these coins will get that treatment. I'm not sure which ones will catch on, but they'll get the perfect, like, fitting coat for you in terms of the exposure you want and the risk you want.
V, what's holding back the general counsels? Like, why are they apprehensive, or are they not apprehensive and they're ready to go and there's other things holding it back?
Yeah, I mean, I think a lot of companies really across the space, right? Because so many different kinds of crypto companies have a stake and an interest in this. I mean, it's a lot of the risks I think we mentioned before. I did want to mention one interesting proposal I've seen
Please.
and this has been presented to the SEC. But this idea of using a liquid staking model to address some of the liquidity concerns.
And for those that don't know, real quick, just what is a liquid staking?
So liquid staking is basically, you stake your asset through a smart contract protocol, and you get a liquid staking token back, and that is just a receipt for your staked asset plus your rewards. And what it does is it allows you to use that liquid staking token to trade it, do whatever with it, even though your underlying asset is still staked. So what that could potentially do in a staked ETF is allow your asset to remain staked, but you can use your liquid staking token and have access to it. And so that's a proposal that has been presented to the SEC, and I just think it's a really interesting way of potentially addressing some of the risks that the regulator has been concerned about.
Are there any other sort of interesting experiments that you've seen out there? And they're big names. Franklin Templeton recently applied for a stakeable ETF. We've talked a lot about the problems, but let's talk, or not the problems, the obstacles. What sort of experiments are we seeing out there as far as solutions? Are they coming from the startup side of the thing? Are they coming from TradFi? How might we see some of these prohibitions kind of be overcome in the future?
No, I think liquid staking are very interesting solutions because you have different forms of liquid staking. You have essentially three forms of them. One is a completely pooled DeFi liquid staking solution where the funds are pulled from potentially US ETF or US customers and pooled with any other users around the world. This, I think, won't fly anytime soon, at the SEC level, because the SEC wants to see and wants to protect US customers. There's another form where you're actually tokenizing the validator, and the validator could be in the US. And it's 32 ETH in the case of Ethereum. Now it can be more. The problem of that is that it creates some liquidity problem because
there's a decent chance that we have folks in the audience that don't know what the validator is. Could you just really quickly talk about what does it mean to tokenize the validator in that example?
Yeah, when you stake your ETH essentially, which doesn't happen on Solana. I mean, when you stake your ETH, you have to spin up a validator that is linked to your ETH that are staked up to 32 ETH, Now it can be a little bit more, but you have to spin up another validator every 32 ETH. So that's just the background, the back end of a staking provider, what we provide. On Solana, it's slightly different, where you're going to stake all of the assets on one validator, right? So let's say BlackRock might have one Solana validator versus thousands of ETH validators in the background when they offer a staked ETF. So there's this concept then of liquid staking. But liquid staking, I think the one version that will fly in the US will be the ones that touches only US customers, right? That potentially pulled, maybe segregated US customers together. And then this receipt can be the base of much more advanced and much more risky type of yields that are built on top of the staking yields through liquid staking products.
Other than liquid staking, anything else that we're seeing out here to sort of overcome some of these concerns and hesitations?
So there's at least one project that is allowing Bitcoin, which you can't stake in the traditional sense, right, because it's not a proof of stake blockchain, but is allowing holders to earn yield off of their Bitcoin holdings. So Bitcoin staking basically involves the investor posting their Bitcoin and earning ETH staking rewards by posting their Bitcoin as collateral on a decentralized collateral platform. So like Babylon Labs is an example of a company that's doing
like
that.
Bitcoin's not a natively stakeable asset, and these are folks that are figuring out how to use it to stake in stakeable blockchains.
Yeah, and like there is already a Bitcoin covered call, and a Bitcoin. There's going to be there's a MicroStrategy yield max. So yield max writes just out of the money call options, which gets you a high premium, and the yield max MicroStrategy yields 160%. So like again, that's why there's a whole world of yield-bearing ETFs that these will have to compete with. But for me, again, what's exciting is Bitcoin's growth, and as basically a hedge against the global money printer. I think if Bitcoin hits 150K, some really interesting things will happen with advisors, 401ks. It could get crazy. On the other side, though, I think these coins, what they need is like a 3-phrase sentence that describes what they do. And I polled Twitter about Ethereum, and I said, how would you describe Ethereum in like 2 words? And some people said programmable money, digital oil. A bit like, a normal person's brain it doesn't make sense. It doesn't compute. Digital gold, it makes sense. So this is the bigger thing I'm looking out for is now, if one of them goes on a crazy run and returns like 150% within a year, that is called a shiny object moment, and ETF investors will be like, ooh, but then you have to match it with a narrative. Like when the robotics ETFs went up crazy, it was like, ooh, and then people were like, oh yeah, of course robotics are popular. I saw the robot doing a somersault on the video, I'm gonna buy this. The narrative part of the altcoins is missing a little. Yeah. Because a lot of what they do seems like business to business. It's not like something anybody can feel or touch. So I'm looking a little bit for how the ETF industry, because they're very creative with marketing, how do they take some of these altcoins and basically narrow them down to a very digestible soundbite in order to try to get people to understand them.
Digestible soundbite, literally just what do they do?
Yes.
You talked a little bit about baskets as well. Where do you see sort of the future of how stakeable ETFs might be repackaged?
Yeah, so you're probably going to have like all sorts of choices. Like you'll have the crypto 10, Bitcoin. The problem is Bitcoin's going to be like, what, 70% of that? In my opinion, I would separate them. I would buy Bitcoin on your own, and then I get the basket for the rest, market cap weighted. Because you want the active players to bid up the good ones, and then you just benefit from that. So if Solana becomes like the big thing and it passes Ether, it will automatically get a higher weighting in the index. So I think a lot of people who don't even understand any of it might be open to that. Because they're like, I don't know who's going to win this race. So that's part of the beauty of ETFs, is you don't have to like study it, you just buy all of them. And they may even get to 50, depends on how far we go into this, but a basket could be a solution for a lot of people.
21 Shares is already offering not just a basket ETF, but a stakeable, like a staked basket of assets through an ETP. It's an ETP, I believe, in Switzerland. So,
In Switzerland, yeah.
in Switzerland.
Yep, and they also offer 37 ETPs in Europe, coins like Aave or Ondo. The ones that are stakeable, those are not.
It's interesting that you talk about what do these assets do. I think it's a fundamental question. To sort of piggyback on something V said about being able to stake unstakeable assets. There's been some applications out to tokenize Microsoft stock. Not by Microsoft, but by third parties that want to basically turn their Microsoft ownership into tokenized assets that can be traded. Do you see a world where we could maybe not have to worry about defining what these assets do because we're staking traditional stocks in stakeable blockchains?
Yeah, I mean, tokenization is a great concept, and I get it for the back office, but to a US investor, they can roll out of bed in their underwear, go over to the computer, fire up Schwab, hit a button, and they own all the crypto assets, all Bitcoin, everything in 1 second for no fee. How do you dislodge that? That said, they can only do it 9 to 5, and it's only US. Tokenization to me is great for a global, so if they can get global 24/7 sold and see some people in other countries buying these tokenized assets, I could see that, but I'm still trying to see what that does to just buying MicroStrategy on Microsoft.
You've got the last word here, General Counsel perspective. What's the likelihood that we see a stakeable ETF approved in the United States in the next 3 months?
So I don't think it's going to happen before we see just a straight spot Solana ETF. That'll probably come first. I think that'll happen soon. And then after that, I think it's any day now.
I think it's going to happen in 8 weeks.
8 weeks, all right, there we go. Put a pin in that. Guys, thank you so much for joining us. It was a great conversation. Please give them a round of applause.